Look, we're 10 days away from the first notice day of delivery for the March silver contract. And I think people really need to understand what this means. As of Friday, there was 58,770 contracts that were left open interest, as it's called, that could stand for delivery. Each contract is 5,000 ounces. So that's 294 million ounces open interest right now for the March contract. A bunch of it has rolled to May, to the May contract, because there was about 400 million ounces a week ago. So about 100 million ounces have rolled to May, which is the next big delivery month, not April, it's May. And that's normal, right? But it's still really very huge that we have 300 million ounces open this close to first notice. So I think what I take away from that is not a COMEX default, but even half of the open interest actually decided to stand for delivery. You're talking 150 million ounces that would need to get sourced, right? The problem with that is that the registered silver category, that is the available silver backing the contracts available to deliver, is about 90 million ounces, right? So, do the math. If demand for delivery spikes, COMEX has two options: either drain registered inventory very fast, which would be, I guess, a very serious drawdown, or you have the price of immediacy increases, where you have forced incentives. Premiums will increase, exchange for physicals will increase. They will try and get people to roll to May by incentivizing cash settlements with a premium, anything to keep metal from leaving. And in my opinion, this is how the stress shows up. It's not in price, but it's in the delivery mechanisms and the delivery mechanics. And when the paper claims tower over the deliverable silver, I think the market is calm until it isn't. And so I think really what you're looking at is even a portion of this stands for delivery. 20% stands for delivery. You're talking, 60 million ounces of the 90 million. This is a problem. And so I think that's, to me, the biggest issue right now. What I'm watching is we'll see what happens over the next 10 days. At the same time, you still have this big $10 premium in Shanghai over the Western price. That this arbitrage is not going away. They're continuing to incentivize the people here in the West who have the ability to buy cheap, $75 or whatever, and sell it for $85 in China. A lot of people say, well, what about the difference in price is the tax. The VAT tax, right? Not tariffs, that there's a VAT tax, which is true, but it's not true, right? These are people who are not quite understanding the mechanics. The VAT tax is really there, but it's the responsibility of the recipient, because when metal is delivered to Shanghai and you get that $10 arbitrage spread, you deliver.
Welcome to the Silver Investing, your premier source for navigating the complex world of precious metals. From the industrial demand driving silver's latest surge to gold's role as the ultimate safe haven in 2026, we bring you exclusive predictions from the world's most knowledgeable investors. Whether you're hedging against inflation or seeking high-growth opportunities, let's dive into today's expert analysis.
Over 50 million ounces at $10, you just made $500 million. That VAT tax is the responsibility of the recipient when it leaves the Shanghai exchange. So it's not paid until it leaves. If it stays there, there is no tax. So in other words, that arbitrage is significant enough at this point for a $10 premium plus like a 13 or 14 or 15% tax. They don't care. They want the metal. And so this is all, I think, noise. You have to see the big picture. You have to relax, see the big picture, understand it for what it truly is. And I think, yes, the volatility is enough to freak a lot of people out. But look, silver is the canary in the coal mine. And I think it's exposing a paper market built by banks that trade credit, not real metal. And real demand is showing up in Shanghai, and price discovery is shifting there. It's leaving London, it's leaving New York, and as long as the Western paper market stays disconnected to Shanghai like it is now, the physical silver will keep getting pulled out of the West and sent to where it's valued. And look, the scary part, it's even getting tight in Shanghai with premiums starting to blow out. And I think that's why, to me, the forwards and the futures are starting to feel almost undeliverable for a lot of people. This is why you're seeing backwardation, where the market makers are having a hard time sourcing metal. They can't hedge easily. I've been saying since 2020 on your show, the central banks have figured it out of the global south. Stand for delivery, slowly. Don't do it too fast. Everyone says, why don't they just throw trillions of dollars at? Because you kill yourself. You cut off your nose to spite your face. They've been masterful at draining the exchanges all around the world. And that slow, insidious, little by little part, people can't handle. It's too monotonous. It's too slow. It's a nothing burger. But as you can see, we're getting to the point where they're running out of available silver to deliver. And that, to me, is all you need to see, on top of who's been standing for delivery every single month, month over month over month over month over month, for billions and billions and billions of dollars. They don't do this for the hell of it. What you see right now is just the volatility meant to throw the rest of us off the scent, off the trail, and join the highest influx into global U.S. equities in history. They want the rest of us in the pen with the rest of the sheep. At the same time, you got billionaire David Einhorn. I don't know if you saw that article, but he thinks that gold is well on its way to becoming the world's ultimate reserve asset. This is a guy that runs one of the biggest hedge funds in the world, and he's saying that it's already replacing treasuries, as we've talked about for the last several years, as central banks' reserve asset, because the confidence in this system, both fiscal and macro outlook, is getting worse. I've never seen a market like this. Never, ever. I mean, let's go back to the pandemic. Premiums on junk, we were paying $9 over spot for 4 years. Anyone that would sell us as much as they would sell us, we would pay $9 over spot. I've never seen a market like this, and it's not just junk silver, although that's been hit relatively hard on the buy side. It's all of the items, with the exception maybe of Silver Eagles. I've never seen anything like it. Let's talk about it a little bit. In an effort, I think, by the CME group to, which is the COMEX, to knock the speculators off their perch, they raised margins significantly. So normally, we'll have 2 or 3 million ounces of silver in our warehouse, and we will hedge it ounce for ounce so that we're market neutral. We'll sell the equivalent of what we have in our warehouse on paper, so one goes up, one goes down. We've talked about this a lot. So
The markets never sleep, and neither does the search for value. If you found today's Investor Insights valuable, smash that like button and subscribe to the Silver Investing to stay ahead of the next major move. What's your take on the current gold to silver ratio? Let us know in the comments below. I read every single one. Thanks for watching, and remember, protect your wealth, grow your future. See you in the next video.